Okay, we're at week 11, day 2. Now this week there's a lot of information. You're now able to really understand a little more about executive decisions, about magic bullets, about squats, bullish divergence. So you're starting to see that there are many different aspects of the market. There are many different things that really are market conditions that make us choose or help us to choose where our stops are. Our goal for this week, or our goal for today actually, is to be able to recognize a wave 4 or a non-trending market and get the best trade location for the next trend without sustaining excessive whipsaws. Now this is basically, this is really what I see in the markets most of the time. A typical trading market. You'll see a market come up, pull back, up, back, up, back, up, back. By the time this move takes off, which is only 15 to 30% of the time does a market trend, you have been whipsawed so many times in here that you're either out of money, upset, mad at the market, or you've gone on and moved to a new market. So this market takes off and you're not there. After this market takes off, you come back because you missed it, and where do you think you enter again? Right back here in a wave 4. So our goal is to be able to help you see a wave 4, know what to do with it, and if you choose to trade a wave 4, how to get the best location, what is the best time frame to choose to trade a wave 4 in. So this is an S&P on a daily chart, and what we want you to see, or what I want you to see, is notice this huge move. Okay, that's a wave 3. Look at your oscillator. You now know that that is a wave 3 by being your tallest peak. Now after the market moves or has such a large trend or a big move, what comes after a 3? Well, we know wave 4 is next. So what we try to do is avoid this area, these whipsaws, because what we also know is after a wave 4 is a wave 5, and we know that 1, 3, and 5 are our impulse waves. That's where you're going to make your most money. That's where we want to be in the market. Where most people lose all the money they've made in wave 3s, or some people never even have a chance to make it to a wave 3 because of a 2 or 4. So we want to go, what I want to do is talk to you about what I feel is best in a wave 4. Remember, all of us trade differently, and all of us see different things in the market. We all have different account sizes. We all have different belief systems. So I feel like that there's enough tools here that you can find a comfortable stop or a comfortable way to get in and out of the market. So at this point, after trading, or after being, if I had been in this wave 3, I'm going to be much more likely to get in the wave 4, not to miss wave 5. If I have missed that entire move here, I don't want to get in here and sustain a lot of whipsaws. And what happens in a wave 4 is you'll see it gets larger and larger. You have a fractal here, you have a fractal here, you have a fractal here, you have a fractal here. Fractal, fractal, fractal. Now, for me personally, after that type of move, look at the length of this move. Okay, that took a couple months. I don't want to trade the wave 4. I know that after the market has been so impulsive, it has to pull back and it has to correct. So at this point, at the beginning of wave 4, I'm not even interested in being in this particular market right now. Now this is an S&P, so it's a little wilder. Some of the markets are going to be different. Remember, each market has its own behavior. Each market acts differently. You know, I look at the markets as having different personalities, like children. If you have 7 children, you do not treat all 7 of your children the same. You may have one that's wild, you may have one that's quiet. You're going to have different personalities, so you're going to treat them according to those personalities. So I look at the market the same way. Now in this particular slide, I want you to see this is a copper on a daily chart. Look at this huge move all the way down. So we know that was a wave 3. We've got divergence here. Now we've crossed 0. We're in an ABC, another ABC. So we're trading a wave 4, or this is a wave 4. Why? On a daily basis, there is no reason to trade this. This is where most traders get hurt. So we want you to be able to avoid it. But also, there's a lot of people that may want to trade this. If you decide that you want to trade this, the place to be, I think, is on an intraday chart, because intraday, this A wave and these C waves are also impulsive. So they have the same characteristics of a wave 3 and a wave 5. So let's go to the smaller one. Now here is a 30-minute chart. What I've done is broken down that A wave and C wave you just looked at. Okay? Now this is coming back on the downside. So this actually could have been profitable. But if you have tried to trade this on a daily basis, it would not have been as profitable. So again, what I'm saying is if you see a market go into a wave 4, it's just been in a very large trend, you may want to go intraday to trade it. You may choose to stand aside and not trade it at all. Okay, here's another example. This is an S&P on a 30-minute chart. It's been in a correction. Look at your gator. Look at it twisting and turning. Look at all these fractals. Up and down, up and down. If you took every fractal here, you would have been whipsawed. You'd have lost a good deal of money. And by the time this took off, you'd have probably been quite upset. But if you chose to be in here, 1, 2, 3, 4, 5, 6. Look at your consecutive red bars. The bar circled here is your exit. So what I'm saying is if you're choosing to trade a wave 4, you need to use tight stops because they move impulsively. If you're going to get in there and get some profit, take it off the table. Don't let it ride. That's my suggestion. That's when I'm trading a wave 4 or a sideways market or a non-trending market, that's what I do. Now in this particular chart, we're looking at the S&P now on a 5-minute basis. Now notice the saddle point here, how long the market's at balanced. And you're going to say, well, here's a valid fractal, here's a valid fractal, here's a valid fractal. Well, I'm going to show you in a few minutes what I normally do. Many times, instead of taking every fractal, I will pick an outer set of fractals, the widest set of brackets, to avoid this inner noise and make sure that I don't miss this move. So at this point, make sure you also watch the gator. The gator's going to let you know what the market's doing. You know, with CQG, we have the well, it's a plus. We are able to see, projected out in time, what's happening with the gator. So before it actually happens, many times I can see the gator's mouth opening up. So now is a smaller time frame, smaller than we were in the last chart. And look at your consecutive bars. I've circled your oscillator, your AO, and your AC. So you had 2, 4, 6 consecutive red bars. At this point, which is a squat bar, it's a 1-1 squat bar, that is where we were stopped out. So again, if you're going to trade a market that's been a little choppy, you're going inside time frames, you're going from a larger time frame to a smaller time frame to trade the impulse inside of a correction, you're going to want to keep a tight stop. Don't give that profit back if you've made it. Now here, this is what I'm talking about. By taking a further out fractal, you can avoid some of the whipsaws in a wave 4. So here you had your big move, right? And then here's your fractal and your fractal. And these are the outer 2 most fractals at the beginning of this wave 4. Now remember, I don't want to get right in the beginning of a wave 4. I would rather get in, hopefully, in the C wave, or hopefully I get in right at the beginning of wave 5. But there's no way for us to really know when wave 4 is going to end, how long a wave 4 is going to be, or how complex or simple a wave 4 is going to be. So what I have found and what we've found in trading is sometimes coming into these outer fractals and bracketing those helps us to avoid all this whipsaw, all this excessive loss through here. Now, and I also watch the gator's formation. If the gator is not shut tightly and spent some time shut after a move like this, I'm going to be more cautious. So where I have circled is where I had my first set of brackets. In case the market takes off again, I'm not going to miss it. Now, you may say, well, that's not a very good trade location. But if you think of it this way, if I were to have taken every signal here and been whipsawed, think about how many points down I would be. Let's just say 50 points against me. Now, the move takes off and I get filled here. Well, I may not be at the beginning of the move here, but I'm not already down 50 points trying to catch up. So I may actually come out of it much more profitable than the person that's taken every signal. So by taking the further out fractals in the beginning of a wave 4, it really may help you to miss this congestion and miss this noise. Now I've circled this fractal because after the market has made these moves, I have changed my down fractal from here, and now I've changed it to here. Because what I'm thinking about also is if you're looking at, and you know a little of Elliott wave now, the last move was up. The general trend is up. So what's going to be coming down are going to be my A wave and my C wave. Well, I don't particularly enjoy trading fourth waves, and especially this is a daily chart. I don't want to be in here. But I don't want to miss the next move. I don't want to miss wave 5. So I'm absolutely have my buy stop here, had my sell stop here, moved it to here. Now, at this point, I'm going to wait and watch the gator's formation. If the gator starts to open up, I may change my buy stop and lower it down a little bit. But at this point in time, that's where I have my buy here and my sell here. Now, here's another example. You had a buy and a sell here at the beginning, and it helped you avoid all of this noise. Now, we've created another down fractal here that you might have chosen to take. Here's another down fractal. This was the one that I have circled because I chose this one next because it was lower than this previous down fractal. Now, you were hit and you did sustain one whipsaw. The market pulled up and closed above the red and the green line. So you were stopped out here, but look, we've created another down fractal. So if you were stopped out, you were right back in. If you never used those fractals and decided to wait till you saw the gator opening, now you're in here short. Look at the gator's mouth. It's wide open. Look at your oscillator. And notice the saddle point which this came out of. Okay, that's very important. That saddle point, we know when the market stays balanced for a long period of time, the move is usually explosive, or it's usually a bigger move the longer it stays balanced, because the market cannot stay balanced forever with no new coming information, or we wouldn't have any markets to trade. So at this point, here's your entry, or re-entry, or here's your first entry if you missed all of those. You see the gator's wide open. Now, if you choose to be in here after your 5 consecutive bars, I want to be stopped out. I want to take my profit. This is a 5-minute S&P chart. Now, you as a trader may say, hey, I see the momentum. I see that the peak is increasing. I may choose to stay in here. My point to you is all of our stops are executive decisions, where we place them, where we get in, and where we get out. But you just need to note the different market conditions. That's what tells me, or lets all of us know, where should I be or where should I not be. Now, in this one, here we go. The market's come up. It's pulled back. And this is a 5-minute chart again. We're looking at some volatile markets. Here you had 5 bars. It's pulled back. And again, you've had another 5 bars. This is where I placed a trailing stop. I'm going to protect my profit in the market. If the market decides to pull back, now I have blown this up. It's just a correction, but it's an impulse inside a correction. So I want to make sure I get the most out of it. If the market's going to give me this money, that's great, but why give it back? We'll place a trailing stop and continue to follow it up 1 tick below the low until the market takes us out. So this is the end of day 2. This is probably one of the hardest places to trade in the market. Go over your computorals, fax us, email us, practice yourself, but remember, all of your decisions are executive decisions, and most of them are based on your belief system. So look at the market, read what the market's telling you, and make your decision based on that.